If you look at the front pages of financial media today, the crypto revolution seems to have stalled. The public spotlight has almost entirely shifted toward the artificial intelligence boom, leaving digital assets in the shadows. This shift represents time-based capitulation. Rather than a sharp market crash, we are seeing interest slowly fading away as investors grow bored, leading to a period of widespread apathy across the asset class. The legislative side is equally stagnant. U.S. politicians are currently locked in partisan brinksmanship over the nuances of the Clarity Act, with the upcoming August recess creating a tight bottleneck for any real progress. This chart shows how stablecoin issuers now compare to traditional institutional holders of U.S. debt. Despite the lack of media coverage, these digital asset firms have quietly become some of the largest holders of U.S. treasuries in the world. While the public debate remains contentious, the private reality is different. Behind closed doors, community banks are holding strategy sessions to partner with digital asset platforms, looking to integrate the technology rather than fight it. The lack of a loud public narrative hides the actual progress being made. This quiet period is masking a deep, structural integration into the global financial system. Some Wall Street CEOs continue to push an emotional argument against this integration, warning that digital yields will trigger a massive flight of capital away from traditional banks. This has created significant friction between the old guard of finance and the leadership of major crypto exchanges, often playing out as a public clash of philosophies. However, the data suggests a different driver for bank departures. When an elderly customer leaves a community bank after 40 years, it's typically because of a clunky, outdated online interface, not a desire to chase complex digital asset yields. When we combine these ground-level trends with the fact that community banks are already seeking crypto partnerships, the narrative of institutional resistance begins to thin out. The primary hurdle isn't a lack of banking interest, it is the ongoing legislative stalemate in Washington. While the U.S. remains stuck in debate, a harmonization of direction is taking place internationally as other nations move to establish clear rules. Japan is a prime example. They have moved to dramatically lower the tax burden on digital assets, shifting Bitcoin from a nearly 60% tax rate down to a 20% capital gains rate. At the same time, the United Arab Emirates has moved rapidly to build out specific, thoughtful frameworks to regulate decentralized finance. This animation illustrates the concept of an opened and permissioned system. It uses a decentralized infrastructure that requires verified credentials, allowing for a network that is both accessible to the public and compliant with regulatory standards. Foreign jurisdictions are aggressively building the framework for next-generation finance, while the U.S. focuses its energy on internal ethics debates. This regulatory friction is a recurring pattern for disruptive tech. Today, the AI industry is facing the exact same level of scrutiny that crypto has endured for the last several years. We see this in the environmental debate. Politicians who previously targeted crypto mining are now using the same reasoning to pause the construction of AI data centers. History shows this is a standard phase. In 2001, the initial reaction to Napster was an attempt to sue it out of existence, right before the music industry realized the underlying technology was inevitable. We saw a similar maturation with the rise of low-latency trading, which forced a national conversation about market fairness that lasted for years. Regulatory friction and public skepticism are standard indicators of a technology moving through its integration phase. These are the predictable signs of a new system becoming a permanent part of the mainstream. This period of widespread apathy serves a specific purpose. The departure of speculative hype has left a vacuum where developers can focus on the technical plumbing required for institutional finance. The macroeconomic stakes of this work are massive. Stablecoins provide a direct way to export the US dollar to global populations that previously lacked access to stable currency. This map shows the process of hyper-dollarization. Digital wallets distribute the US dollar faster than traditional routes. This system also applies to tokenized equities, allowing anyone with a smartphone to buy US shares, drawing global capital back toward American markets. Providing this level of frictionless access is a powerful marketing tool for the American economy. It encourages global populations to bet their financial futures on the success of U.S. corporations. While concerns about global de-dollarization persist, Making the dollar and U.S. equities easier to hold counters that trend by ensuring our financial products remain the most accessible in the world. The United States now faces a choice between leading the development of this open financial era or waiting while the rest of the world sets the standards for the future.